Hey, everybody, welcome to Cigars and Syndication. I'm Robbie Rogers, and I'm here with my co host, Jay Noir.
Hey everyone, welcome to Cigars and Syndications. What are we smoking today, Robbie?
Today, we're smoking Davidoff Year of the Rabbit, and it is so far a really good smoke. It starts off really creamy and peppery. I'm really excited to finish this smoke off. What do you think about this cigar so far?
I have tried a few different cigars in their Davidoff or Davidoff, however you want to pronounce it. They have their Zodiac series. I've tried a few different ones. Um, the Year of the Dog, Year of the Rat, Year of the Pig, Year of the Rooster. Every Chinese New Year, they come out with a different blend. Um, this is the first time I'm trying this, which is the Year of the Rabbit. It is a very, very good smoke. I get pepper. I get a little bit of nut on the top of my palate, and I get some coffee, and a little bit of leather too. What do you think?
Well, I totally agree. It really hitting all the high spots for me. I'm enjoying the smoke so far. It is just a little bit about the Year of the Rabbit. It is a Honduran wrapper. It has a Mexican San Andreas binder and a Dominican and Nicaraguan filler. It is a double perfecto. So hopefully we can continue to enjoy this smoke throughout our podcast. And today's kind of a slippery slope. We're going to talk about 2023 predictions.
The first prediction for 2023, and I think the most important one is next year, well, it should be by the end of 2023, maybe early 2024, Davidoff will release their Year of the Dragon. Now, the Year of the Dragon we're very excited about the Year of the Dragon because we're looking forward. Not only does Davidoff make some great cigars in their Zodiac series, but they make beautiful boxes. And we're looking forward to that box. Now, the last time the Year of the Dragon, they didn't really release it in the United States. They released it in Asia. And it was in 2012. It was a very limited release. So I'm really looking forward to the Year of the Dragon being released.
So this will be the first time the Year of the Dragon will be released in the U.S.
Yeah, so they released it as under a different label. I think it was called the Cuvée 2012 label. And I was reading about it. They have it at the Davidoff Vault in New York. But this will be the first time that they actually release a general release of Year of the Dragon, and I'm very, very excited about it.
Well, today on the podcast, we're going to get into predictions, and that's going to entail quite a bit about the stock market, about real estate, about inflation, about interest rates. And it should be a really interesting podcast today and hopefully shed some light on your 2023 and how you want to invest.
So, Robbie, the biggest culprit for 2023, 2022, and going forward to 2023 is inflation. And, as a result of inflation going up, the Fed is going to keep raising rates. And, that's going to affect every kind of asset class. It's going to affect the stock market. It's going to affect real estate. It's going to it's already affecting the residential housing market. And it also affects investors. And I think we'll get into that one by one and, what your thoughts are, what my thoughts are. And again, to the audience out there, these are our individual opinions. What we say here is for our own portfolio that we're going to be adjusting our portfolio accordingly, and what may be right for us may not be right for you. So, this is mainly for educational purposes, and these are just our opinions.
Well, in regards to the stock market, you hear a lot of people talking about, the stocks are overvalued and there's going to be a true up and things like that. Do you think this is going to kind of expedite that a little bit?
You know, um, the thing with the stock market is that the stock market is very dependent, especially tech stocks are very dependent on interest rates. And so most all the predictions that I'm reading about stock market, and I own stocks myself too. I have stocks as a part of my portfolio, and I'm losing money on some of them, honestly, just because I thought that world events would go one way and they went another way. I bought a lot of Alibaba stock when it was relatively cheap, but it dropped more in value. And basically, what I'm just going to do is just hold on to it until it increases in value.
Well, and you're a young guy, and ultimately we're investing for the long term, and you've kind of got to ride the highs and the lows. And I think the important thing is to keep investing. You may change it up, maybe get more conservative, but ultimately you just keep investing.
Yeah, and I agree with that, right? And it's just about long-term hold. But as far as interest rates go in stock market, the stock market is very sensitive to interest rates, and everything I'm reading, all the predictions I'm reading, I think, and I agree with those predictions that, we will bottom out in the stock market probably by the middle of 2023. The Fed will continue raising rates even if they're a little bit slower now. If they do a half a basis point in December, and then they do a half a basis point in January and going further, but they're going to continue raising rates. And then what they usually do is they hit the brakes really hard, like they hit the accelerator really hard, and they're going to start pulling back because we're going to be into a full-blown recession by the middle of next year.
So you're thinking, or you agree with some of the predictions that we've been reading that this is going to continue. The interest rates are going to continue to rise, and the stocks are going to continue to fall, and maybe stabilize sometime in the summer.
Yeah, that's what I think. I agree with that. And again, when you say stocks are going to rise and fall, we're never talking about individual corporations or individual stocks. We're talking about indexes, right? Indices. So we're talking about the Dow, and we're talking about the S&P 500 as an overall market bag. We're not talking about, oh, Apple in itself might do well, or Microsoft might do well on its own. We're just talking about the mixed bag.
Yeah, earlier you had mentioned the housing market, and I think that's coming to the forefront, and I think it's gonna be a escalated situation with housing, and mainly because of the institutional investing in housing.
Yeah, housing is a little bit weird this time around because the normal pattern is as interest rates go up, prices of houses go down. They usually move inversely, but this is odd this time around. The interest rates are going up, but prices are not really going down. Now, people are leaving the market because interest rates are going up, and people who could afford a $300,000 house can now afford a $200,000 house. But prices of houses are not going down, and mainly it's because we have a shortage of housing everywhere. All major cities in the United States have a shortage of housing. Um, and I mean, you work with a lot of developers. What are you hearing from the developers as far as building new single family construction?
Well, I've been hearing a big buzz about BTR. It seems like there's a lot of groups that are very interested in the build to rent model because of the rising interest rates. In some cases, the home buyers monthly payments have almost doubled, and so it does put them out of the market. And I think those families they still want the yards and the driveways and the garages, and in that case, the BTR is a really good choice.
So BTR is basically, when we refer to BTR, we're referring to a community of single family homes which are all rented out rather than sold. Correct?
Correct.
So interestingly enough, Zillow had a prediction out, a very bold prediction, saying that um, the housing market, the single family housing market, is still going to increase because investors are going to keep coming into the single family housing market, even though homeowners are leaving that market. What do you think about that?
I mean, I would think that they're probably trying to maybe pick up on some equity advantages, maybe distressed, people that maybe didn't get a fixed rate, maybe they have a variable rate. In those situations, maybe they feel like they can acquire these assets and have an equity position day one.
So you think that investors are going to come into the market? I mean, I had a lot of homes that I had invested in, which were rental properties. I don't know how much higher can rents go if you're buying at a higher rate because housing prices have not gone down, interest rates are higher. Can you actually charge that much rent and be able to occupy the property and not have to pay out of your pocket?
And again, I think we're just talking about predictions, and me personally, I don't 100% buy into that. I think I see an opportunity for a lot of the institutional investors to pull out and maybe invest in bonds. I mean, their rates are at 3.5 to 4, and some over 4. And if they get into a housing situation and their cap is 3, why wouldn't they just go to a bond?
Exactly. You know what? I would not invest in a three cap property at this stage, especially when, a 10-year treasury, which, theoretically is backed by the full faith and credit of the United States government, but it's guaranteed, right? It's a risk-free rate of return. So everything goes off of your risk-free rate of return. If you're getting a 3.5% or a 4%, I think earlier in December, a couple weeks back, the 10-year treasury hit 4%. So, some of these properties like in Phoenix and in Miami that were hitting three caps. But why would we get into a three cap if you can get 4% risk free and get a 3% return on a multifamily project where there's risk involved?
Earlier you touched on rent and where it's going to go, and I think that's a very interesting topic. I mean, do the BTR communities, do the multifamily communities, is there opportunity for those owners and investors to continue to at least, capture their increased cost in rising rents?
I think there is an opportunity for that, but again, how high can they go, right? So we're starting to see a normalization of rent trends, basically meaning that where rents were going up 12 and 15 and 16 and 18 and 20% over the last few years, now they're going to start normalizing back down to 4 and 5% is what the prediction is. Even though we underwrite our rent increases at only 3%, and it's the same thing with values of multifamily properties, right? And up through the middle of 2021, I believe, the values of multifamily properties were up by 20%, and they're coming back to earth now, which is, around 8, 9, 10% increases in value. So, now that we're seeing this normalization trend, it'll be interesting to see how this pans out because rent can only go up so high, right? I read a report yesterday that said that people increases in salary are about 5% right now for this year, between 5 and 6%. I'm reading. Well, if rents are exceeding that, they're going up by 12%, which is double of what salaries are going up by. There is a cap that people are going to hit before they can no longer afford that unit or that property to rent in, and they'll have to go down from that Class A or Class B to a Class C or a Class D. The only problem is there's still a restriction in supply, right? There's no Class C properties, or at least in Houston, there's not that many Class C properties or Class B properties that have any availability. Most all of them are 100% occupied.
Yeah, and that really is going to put a pinch on the market. And I don't know if as a owner of a multifamily unit or BTR, I don't know what that necessarily means in what you get to do with your rental rates. But I do feel like they would be. I think they can still increase in certain markets. I mean, some of these markets, Phoenix and other areas that were really hot and had heavy institutional investment. I'm not sure because this is a new component to the whole economy, and or at least in this market, and I don't know where it goes from there. It's really, I think you have to do your due diligence and get into the market in an equity position like what you were saying, but then I think recognize where the value of the property or investment is at today, and understand that it might not be at its highest point, it might not be at its lowest point, but where it's at in that peaks and valleys, and understand that it might take a year, 2 years, 3 years for the value to get back up to what it is that you bought it for today.
And that's really what it comes down to, right? If you're looking at long-term investing, if you're looking at growth, and this is one of Buffett's quotes, right? That it doesn't matter what the stock market does, as long as you are buying your assets at a discount. It doesn't matter if the stock market goes up or down or goes sideways, and you have a long-term horizon to hold it. You know, it'll even itself out within the next 4 or 5 years. Now, real estate and all these assets, stocks, bonds, it all comes down to holding power, right? If you're able to just ride the down periods, then you're going to do well in the up periods. The other thing that, because of the environment, I feel investors are going to be much more picky on what kind of assets they invest in. They're going to want quality. They're going to want, they're going to want sustainability, and they're going to be very, because you have a lot of investors with a lot of cash, and so they're going to pick and choose where they invest. They're not just going to throw their money in 8% and 9% returns.
Speaking of assets, I think that this Davidoff Year of the Rabbit would be an amazing asset to any humidor. Really enjoying this cigar so far. What do you think?
Well, it's only an asset if you don't smoke it, if you can resell it. If you smoke it, then it's gone. But man, this is a really good smoke. I'm really enjoying it. It's really mellowed out now, and the pepper is gone, and there's a lot more coffee now, I feel. What do you think?
Yeah, I'm getting a little bit of coffee. I'm getting some, maybe just a little bit of cedar. It's a really complex, but incredibly smooth. The burn has been amazing, and the double perfecto was an amazing choice for the shape of the cigar. Really enjoying this cigar.
Another issue that a lot of people don't consider is climate. Now, whether you believe in climate change or not, climate is one of those things, or the change in the climate is one of those things that will affect real estate demand. So a lot of people don't remember this, or maybe they haven't thought about this, but between 1930 and 1940, we had this issue called the Dust Bowl. And what happened was, about 3.5 million people left the area of Texas, Oklahoma, and Arkansas because of severe drought and soil erosion. And I understand we were back then, we were much more of an agrarian society. And, we really didn't understand water movement and erosion control. But nevertheless, in areas where you have a lot of drought because of climate change or just because it's getting hot, we were talking to one of our friends having cigars, and they live in Phoenix, and they basically said, water is becoming an issue in Phoenix. It's difficult for them to find more water, and it's becoming a problem, especially in drought summers where there's a lot of drought. Well, if water becomes too expensive or it's hard to obtain, people are not going to move there, and those areas will see a decline in property demand.
Yeah, and I totally agree with that. And there's climate, there's taxes, and other issues that can really impact a certain area, a market. So to do your due diligence, understand and partner with somebody that's relative in that given market, and understand that there are certain things that are going to impact the value of your investments.
So now that we've covered a lot of different aspects of our 2023 predictions, the cigar being the most important. Robbie, where are you putting your money next year?
Well, I would have to shoot you if I told you. No, but seriously, I always do. I have money in the stock market, probably 25 to 30%, and it's a long term game for me. You ride it out, and you protect yourself the best you can and do your homework. But a big portion of the money that I use for investments is in real estate.
Yeah, I agree with you. A lot of it is going to be in real estate and mainly because we understand, right? We understand the development process. We understand. We stay in Houston because we know the economy, we know the geography, we know the demographics. We basically understand where we are, and that's the big thing with real estate, as well as with stocks too. When you're investing in stocks, you have to understand the industry. You have to understand that the business that they're in, understand management, what they're selling, how they're going to make a profit. And we had an episode on speculation versus investing, and we covered the same topics. That you really have to understand what it is you're getting into before you put your money in. And real estate is something that we know really well. I feel the same way. My stock portfolio is going to be a little bit less, probably about 20% or so, and then 80% into real estate. And I think that will be good over the next few years, especially since we purchase land and we do development, and that development takes a little bit of time to come to fruition.
Well, I hope everybody is passionate about real estate and cigars as we are. I hope everybody enjoyed this podcast as much as I enjoyed this year of the Rabbit. Really good smoke, and I've been waiting for it for a few months, and it's here, and we got to enjoy it today on our podcast. If you find one, grab it because they're going to be gone quick. Um, if you want to know a little bit more about real estate and a little bit more about Albany Park Capital, look us up on all our social medias, go to our website, look at our resources, read our articles, and feel free to contact us if you have any questions.
And leave some comments. Leave some comments on how you like the podcast, how you like the articles, and how you like the cigar. If you smoked a Year of the Rabbit, I'd love to know what your thoughts are versus what we think about it. And thank you for joining us.
Thanks, guys.